Hello, and welcome to the 10th and final chapter in our series covering the changes enacted by the Tax Cuts and Jobs Act. In this chapter, we will try to demystify estate and gift taxes. Over the years, probably the most asked question I received is related to inheritance. The common question sounds like, I received some money from my grandmother when she passed away. How much will this cost me in taxes? This is a common misconception. There is no such thing as inheritance tax. When you receive money from someone after they pass away through their estate, you do not have to pay tax on that money or property. If there were taxes to be paid on the property or money, it would have been taken care of before the money was distributed to the heirs. That is what is referred to as estate taxes. Estate tax, or more commonly known as the death tax, depending on which side of the aisle you sit, is a tax levied on the net value of the estate of a deceased person before distribution to the heirs. When someone passes away, all their assets, cash, investments, and property values are added together to come up with the net value of the estate. Once that value is determined, it will be taxed at the estate tax rate, which has a maximum of 40%. Now, before you get too concerned that the government is going to come in and take nearly half your money, there is what is called the unified credit. The unified credit is a reduction of the net value to determine how much is subject to the estate tax. Works kind of like the standard deduction on your personal tax return. For 2018, the unified credit has increased from $5.49 million to $11.18 million. What this means is, if the total value of the estate is less than $11.18 million, there will be no estate taxes due. If your estate is greater than the tax credit amount, the value above the credit will be subject to the estate tax. Once the estate has been settled, then all the property from the estate can be distributed to their heirs without any tax issues. Another item that is highly misunderstood is the gift tax. The gift tax is a subset of the estate tax. It is designed to prevent people from giving away the value of their estate in order to avoid the estate tax. The gift tax is a tax imposed on the transfer of ownership of property. The biggest misconception about gift taxes is who is paying the tax. The gift tax is actually paid by the person giving the gift, not the person receiving the gift. The gift tax uses the same tax rates as the estate tax, which has a maximum of 40%. There is an annual limit that is excludable for gift tax purposes. That limit increased in 2018 from $14,000 to $15,000. Therefore, you can give a gift to an individual up to $15,000 within a calendar year with no issues from gift taxes. That limit is per individual. So, what if you want to give more or transfer some property to someone? Are you stuck paying the 40% tax? Well, not necessarily. The tax law allows you to give the gift or transfer the property, then reduce the unified credit that we talked about previously when calculating your estate taxes in the future. To process this, you will need to complete a Form 709, which is a U.S. gift tax return. Here's an example of how it works. A taxpayer wants to go ahead and transfer their home to their child. At the time of the transfer, the home is valued at $400,000. So the total value of the gift is $400,000. The annual exclusion is $15,000. This leaves a total value subject to gift tax of $385,000. Assuming you have not reduced any of your unified credit in the past, you are entitled to a total credit of $11.18 million. Processing this gift, you can reduce your credit instead of paying the gift tax. After this transaction, your unified credit is now $10,795,000. You would use this number in the future if you give any additional gifts or you need to process your estate. Another area surrounding gift taxes is contributions to a Section 529 education savings account. Contributions to a Section 529 plan is considered a gift. Therefore, any contributions in a calendar year in excess of the gift tax exclusion limit, which is currently $15,000, may be subject to the gift tax. However, there is a special provision concerning 529 plans. This provision is called a 5-year election. If there is a lump sum contribution to a 529 plan in excess of $15,000, the contribution can be treated as if you were given the amount over the next 5 years. Therefore, currently, you can contribute a lump sum to a 529 plan up to $75,000 without any gift tax or having to reduce your unified credit amount. So, grandparents, if you want to front load your grandchild's 529 education savings account, you can do so up to $75,000. Now, keep in mind, if you do use the 5-year election, your annual gift tax exclusion to that child will be reduced by the total amount of your contribution divided by 5 for the next 5 years. For example, if you choose to contribute $50,000 and use the 5-year election, it will be treated as if you gave the child a gift of $10,000 per year for the next 5 years. Therefore, you only have $5,000 per year left to give without processing the gift tax or reduction of unified credit. I hope this clears up a few issues and misunderstandings about estate taxes and gift taxes. Thank you for watching this chapter. We greatly appreciate your time. We have enjoyed recording this video series and hope you find the information informative and helpful. This concludes our series, but please continue to follow us on Facebook as new issues may come up. And with our government, I am sure they will. I hope you have a wonderful 2019, and if there's anything we can do to help, please reach out. If you need help in preparing your taxes or have a small business that needs assistance with bookkeeping or payroll processing, we are taking new clients. Reach out and we can discuss. Thanks for watching.